Welcome to another segment of Macro Matters podcast. Here we are, the end of February, right before Nvidia earnings, and it'll be an exciting time to talk about the markets. As always, my name is Rich Excel. I'm a member of the CFA Society of Chicago and professor at University of Illinois, and I'm joined by my colleague in both, Tony Zhang, from U of I and from the CFA Society. So, Tony, welcome. Good to talk to you again.
Yeah, hi, Rich. Good to talk to you again. It's like it has been quite a while. I really like you mentioned the point that we are actually doing the podcast right before the Nvidia's earning, and as we every people watching or is watching that since the release of DeepSeek and many of this kind of AI stock have promised since last month, and now like the earning announcement, especially I think the outlook from the earning announcements will provide a very great foundation or information for the AI stock. Looking forward, I think everyone, I think most of the investors are focusing on the earning announcement right after market close today. I think it's a great, interesting thing to talk about a little bit. Maybe we can talk next section.
Maybe next time. You're right. I mean, it obviously the biggest stock on the biggest theme in
Yeah,
one of the biggest momentum markets of the last couple of years. But we aren't going to talk about Nvidia today. The
all right.
expectations are quite high, and
Quite
I
high, quite high.
do think it matters. But I think it'll be interesting, and you're absolutely right. Maybe we'll save that for a couple of weeks. But there's been a lot of other stuff going on, a lot of other things in the headlines, a lot of other quote macro news, and this is of course macro matters. And so I think we're gonna start by looking through some of the things that have caught our eye that we think are particularly interesting and most importantly, particularly relevant for CFA members to look at. As always, as I tell my students, the most important thing to start looking at is the 10-year US Treasury yield. We've talked about that several times. Of course, every time I talk about it, Tony, it's starting to break out, and I think it's going to go to 5%. And invariably, it turns around and goes the other way. So I'm clearly not in very good sync with the bond market right now, but I think when the bond market moves by, whoops, sorry, can you still see that?
Yes, yes. I
Okay.
still see the US 10-year.
Yeah. So when the bond market moves by 50 basis points or more in a very short period of time, as it has this year, after having hit 4.8% in the early to mid January, and now as of today, we're down about 4.25%. I think it's noticeable, right? And
Yeah,
typically, when we see that, it's because the expectations are that the Fed's going to cut rates aggressively and the equity market likes it, et cetera. But maybe this time around, it's people are a little bit more worried about the cuts to government spending, the cuts to the deficit, the cuts to employment in DC, which likely have very positive long-term impacts, but are certainly a hit to growth here in the short term. And then that might be what we're seeing in the bond market. But I don't know how you're viewing the moves in the bond market this year, Tony.
yeah, Rich. The bond yield movement apparently is very uh, interesting to a certain extent. That basically saying that it actually contradict to what markets have already believed right at the beginning of this year. And since like I think President Trump moved into the office, and every people is actually was worried about that he might actually continuously one perspective is he's going to continuously cut the budget spending, and simultaneously on the other end, it's like to really make like economic strong, then apparently he has to continue to raise and issue the new debt or bond, government bond to actually to support the economic growth. So we actually are seeing like a two force like a moving on the same side. And because like everything, every people might worry that for everything that what he has done, for instance, like something that what he intended to say, we are going to continue to cut the corporate tax rate from the 21% maybe down to 15% if it were made in the United States, which I highly believe this could be a great thing, but simultaneously it also serve as an incentive for the high inflation. And given the high inflation expectation and with a strong U.S. economy, the inflation expectation would definitely go higher. And on the other end, when inflation go higher, now here what we typically would anticipate to see will be that the 10 years yield will actually just break out and goes higher, rather than just turning down and coming to negative. So this is contradict to many investors, especially institutional investors, believe. Apparently, I think the multiple just falls behind that. Apparently, with given the recent the Doge's movement, cutting the government spending and simultaneously laying off all federal workers, this the potential would have the potential impact over the GDP growth. So this is might actually spook some investors over the certain concern that the economy might actually turn negative and the GDP growth for this coming quarter will turn much lower than initially anticipated. This is how I actually interpret I think the bond yields movement. Yeah, Rich, what was
Yeah,
your
you make a lot of great points, Tony. I mean, I think I'm trying to just listen to what you hear and not get chased around too many different random headlines. But I mean, Treasury Secretary Bessent, who was a hedge fund investor, macro hedge fund investor, understands markets very, very well, has taken great pains to consistently tell the market that they should focus on yields. They should focus not on short-term yields, not on the Fed, but on long-term yields, and not on the stock market, but on the bond market. And I think my sense is that message is as much for his boss, President Trump, as it is for the market, because President Trump has been known to pressure the Fed to lower rates and has been known to worry too much about the stock market. But I think Secretary Bessent understands the big task ahead of the government, which is to cut the federal deficit, which has been running in a pro-cyclical fashion to the tune of 6 to 8% the last several years, and cutting that even down to 3% of GDP is a massive drag on the economy that we may not be able to see domestic firms pick up in the short term. And so I also think he knows that he needs to sell $7 trillion worth of debt this year because he was dealt a bad hand, and Secretary Yellen left him with a bunch of short-term debt to roll over. So the focus on the yields completely makes sense, and the focus on policies aimed at reducing the deficit and reducing those yields definitely helps the bond market. And I think the idea here is try not to overthink it. This year, 2025, is already starting out to be a year of bonds versus stocks, and where if growth is falling, and the Fed, is not necessarily going to be there to be super accommodative. I think we have to understand that this growth shock can hurt stocks, but as long as the bond market favors this and the U.S. government's able to fund itself, that could be positive. As usual, when you look at the Treasury yields, you like to decompose them of what's driving this. I think we talked about this before around the election last year and even early this year about how it was the combination of inflation expectations, but also term premia moving higher that took the bond yields from 3.6 to 4.8%, et cetera. Particularly the term premium, which was the concern of the government crowding out the private market. We've seen the term premium fall down considerably to the tune of about 35 or so, maybe even slightly more basis points of that 50 basis points move in treasuries, and inflation expectations are down about 13 or 14 basis points. So it's really the inflation expectations coming lower, but more importantly, the term premium, which I think you can view that as, again, the bond market thinking that the government is finally starting to right the ship somewhat. So I think you can see that through a positive lens for bond investors, even if it's negative near term for stock investors. But I think as we were talking about before the call, it's looking across not just the 10-year, but all yields. And it's not just the 10-year that's come lower, but longer dated yields. Like we've almost fallen 50 basis points in the 30-year yield as well, that's a massive move in terms of duration. So clearly are seeing a big reallocation, perhaps from asset allocators out of equity markets into bond markets. And to me, that seems to be the story. What do you make of especially the longer dated yields starting to fall, Tony?
Yeah, Rich, you are perfectly right about this. We definitely uh, witnessing the largest like outflow from the equity market into the bond market, then typically it's indicating some defensive movement of institutional investors to a certain extent. And if we actually look at the M7 Magnificent Seven's performance year to date, and we saw pretty much half of M7 deliver negative returns since like the beginning of the year and year to date right now. That's actually a very good indicator about investors' sentiment. So they mainly just turn like into negative, especially from those momentum stock. This is actually a major a movement that we continue to see. This is cannot be done without the main institutional asset allocation. This is not done by retail investors. This is aligned perfectly well with what we have seen. I think this like institutional investor has a lot of reason to make such kind of a justification. For instance, given the what Doge movement and government cut spending, some future or employment like a prospect going forward, at least for the rest of the year, might become slightly obscure and at least not as clear as many people believe at the end of last year. Now we know that why the labor market was actually so strong in the last couple of quarters. Apparently, government spending and federal agency recruitment was one of the majors, like a source for all of this kind of labor market. Now here, with if Doge continue to actually cut spending or maybe lay off people, like what they say they want to lay off, like more than like a tens of thousands of government workers. This actually could put a huge pressures for short-term government spending. And this is I think for short-term economy might see some kind of volatility given here, and that's why I think institutional investors, when they were kind of a more of a sensitive toward this kind of movement and uncertain, it might be actually from their point of view might be rational to actually move. But from my actually perspective, if you from the macroeconomic reading in U.S. economy remain actually quite strong. And if you actually look at some pulling down the yield here, 10-year, if especially the long-term yield typically was actually driven. It's driven actually by institutional investors, like mainly like big institution. And given the low rate, as what you just decompose, we might actually see the low inflation. And if this is low inflation moving toward the right direction as the Fed would anticipate it, we might expect the Federal Reserve might continue to cut the interest rate, or even actually to cut the interest rate more surprisingly than what we expect. Richard, you pointed out that President Trump pressures like a Federal Reserve to low interest rate continuously, right? Apparently, he continued. He said he believed that the government, the president, he should have a saying about the interest rate, not purely by Federal Reserve. Now, however, whether the Federal Reserve would cooperate or something to the long run, we do not know. But actually, given the short run, we do see some short-term opportunity for Federal Reserve to continue to cut interest rate. And given what have been moving over the long-term yield, it's actually is declining, but it's not declining at a certain point that would actually concerns me or concerns a lot of institutional investors. That's just my take.
Yeah, I think you're right. And I think the interesting thing to me is, as you're kind of highlighting, when we've seen these kind of moves in the bond market before, these moves towards getting long duration, oftentimes, we see that same sort of move in the equity market, move towards getting long duration, right? And that's because the expectation is you're going to see rate cuts, and those long duration equities tend to be growth and momentum names that benefit from a move lower in rates. We're not really seeing that this time. Maybe we will after Nvidia, we don't know, but that is to me something that seems to be a little bit different right now, is that the move in the bonds is a lot more suggesting a more defensive
Yes.
move for equity investors as well. But at the same time, I just wanted to bring up this chart, which is this is just the world equity indices to show that it's not a disaster, even though we've had a tough month, if you will, in February. The U.S. stock market is still pretty flat for the year, right? Maybe the Nasdaq's down a little bit, S&P is pretty flat, Dow Jones is up, but the overall global equity market is having quite a good, excuse me, quite a good year. Double-digit returns already this year across Europe. Seeing strong returns in Hong Kong and starting to see some returns in China. This is a pro-growth, a pro-global growth move that seems that we're seeing. And maybe this is just a reallocation out of U.S. stocks where investors have done well for the last few years, and moving more to growth opportunities elsewhere, which I think many people would find surprising, particularly with all the talk about tariffs and things of that nature. I know we're going to get to it in a little bit, but I think that's kind of an interesting trend here that we're seeing all these different countries, especially in Europe, materially outperforming the US.
Yes, very interesting. And given what had been happening over there, um, in especially right now, investors I own or actually showed some expectation that we might actually see the ceasefire between Russia and Ukraine maybe in the next 100 days if President Trump keeps his promise. If he delivered the ceasefire, this actually can provide a greater opportunity for rebuild or reconstruction of Ukraine. Well, aka like a maybe high growth for the Europeans, like economic growth as compared to what we have seen over the past couple of years. And at the same time, if this is a reconstruction or rebuild of Ukraine, could be a big themes. That means like China can benefit from the reconstruction as well, especially like given nowadays, like which country have the largest like construction capability. I think if we actually look around the world, China is still the one of the largest like players like in this field. So now here, if markets is looking forward, it's forward looking, then they would definitely would actually prepare to say if we do see the ceasefire, we do see the rebuild above the peace agreement. Now, this is definitely could set up a very great foundation for the European market, and also the Asia market, especially the Hong Kong Stock Exchange here to deliver even stronger performance if like we see the ceasefire. So that's I think aligned with the macro movement and political change. It's like and so on. Now, given the American First policy adopted by President Trump, some of the capital might actually flow out from the United States. Actually, slightly different from what President Trump might actually love to see that if actually like the we actually trying to maybe I should say break apart from the allies or alliance with the United States traditional in the Europe or in the like North Canada, some of the capital, especially the institution within the Europe, they might actually reconsider about their maybe allocation from uh, cash flow point of view. So that's I think what a lot of people, a lot of uncertainty here, and how the policy would actually go move forward. This is even um, President Trump and the whole administration actually aligned very nice about the or trying to adopt the American First policy. Theoretically, it could actually help the U.S. to grow even faster over the long haul. But short term, lots of relationship rebalance might actually spook the market to a certain extent, Rich.
Yeah, I think that's interesting, and I think the America First ideas seem to be more aligned at less of a one trading system globalization and more as a multilateral type of idea. Um, I don't know what you think, but there's been some talk in certain circles within social media, et cetera, about this idea of the Mar-a-Lago Accords or MALA. Every time there's a need for large trade adjustments, we have these accords like the Plaza Accords or Bretton Woods or things of that nature. I mean, we haven't had one really in the last 40 years since the Plaza Accords, but the chairman of the Council of Economic Advisors for the Trump administration is a former hedge fund advisor named Stephen Mirren, and he wrote last fall about a need for a global adjustment in trade. And we've seen, while we haven't necessarily seen a whole bunch of people going to Mar-a-Lago and signing some accords, a number of the things that Stephen Mirren talks about in his paper are starting to come to fruition, or certainly been mentioned by President Trump. The number one thing is the one that's really been the kind of the topic for the president since the first administration, which is the trade deficit being too high, and that's
Hmm.
certainly something that he's talked about quite a bit. The another is the need to rebuild U.S. manufacturing, as you mentioned, with America First, et cetera. And both President Trump and Vice President Vance have talked about that and bringing jobs back to America, et cetera. But for manufacturing to be competitive globally, we need a much lower dollar. And
Oh,
that's something that I think we're starting to hear that take over, and you're seeing some moves within the FX market that suggest it's going on. But also, as we were talking about before with yields, the U.S. has taken on a lot of debt, by some estimates, too much debt in terms of defending Europe. And we saw in the first term the president asking NATO to pay more, pay up to 2% of GDP for defense. Now he's out asking them to pay up to 5% of GDP for defense. And increasingly, you're starting to see some prime ministers, or in the case of Germany, newly elected officials that are sympathetic to this idea that Europe needs to defend itself and maybe be more willing to spend. And the idea is that if they're not going to spend themselves, then they should be paying the U.S. in terms of by buying long-term debt from the United States to fund that. And so I
right.
think the fact that you're seeing Germany, which has the most capacity probably to stimulate its economy because it's only about 40% debt to GDP, you're seeing that, including the defense stocks in Germany, rally considerably, but you're also seeing the bond market in the US rally suggests that maybe some of this move that we're seeing is some traction behind the idea of these accords or some of these policies that have been announced or executive orders starting to take hold. And you're seeing that in a reallocation to Europe because of the potential for stimulus spending from that government. And you're seeing it from in the US because that means a reduction in spending by the US. And so less government spending in the US, more government spending in Germany and China means Germany and China economies and stock markets are doing much better, and the U.S. stock market is not doing as well. But well, I want to move along pretty quickly and look at some of the factors, right? As you kind of mentioned
Yeah.
before, if we look at the factors that are working the best in the market, and I'm using a sector neutral long short factors here, but you see that low volatility, large cap, high dividend yield, value, quality. Those are the factors that are working the best. Growth and momentum are the factors that are working the least or working the worst here. That sounds like a defensive rotation within the stock market where the most stable defensive names are doing well and the higher growth names are doing less well. We've certainly anecdotally seen that. But when in your factor work, Tony, are you seeing anything different?
Well, yeah, I actually see exactly the same thing as what you are actually shown here. This year, low volatility stock, high dividend payout stock, and value stock are slightly outperforming the growth stock, and especially over the past 2 weeks when a lot of momentum stock, especially AI related stock, plummet from the top, from their top when they actually reach to like a all-time high. This is not surprise to me, and could be a very normal just market like rotation, given a lot of hype and expectation for those kind of AI related stock just in the past maybe 1 or 2 quarters, right? We continue to see few of the AI like related stock like Cloudflare and uh, like Nvidia, Palantir, they all actually rally like a 20 or 30% right out of the earning announcement. So, and even as reaches to maybe 50 or even 100% for certain like a AI related stock, then it actually was actually great indicator about the market's like overhype, overheating within some retail investor. So like a pullback like this, sometimes it's a very natural and it's not completely surprising to me. So here, a lot of the issue that what we have seen here, this is a company, even though they have like a pullback from the right now the peak of since like 2 weeks ago, their fundamentals had no change. Fundamental remain to be very solid. For instance, like one of the centers of the AI companies is Palantir, and a lot of people just worried that, oh, maybe the Doge would cut the government spending from the DoD, and DoD actually cut some of the contract or agreement with the Palantir. But lots of um, the companies continue to confirm they are going to increase their capex over the AI and continue to adopt the AI within the operation, right? So this is a very normal process, like for when we encounter some kind of major technology innovation, and given the AI at this time, I think everyone would agree that like a generative AI is another major like technology innovation or revolution right here. And for a long run, a lot of people, a lot of the company continue to invest into the AI would definitely help to increase the productivity and decrease or increase the gross profit margin. This is a major driver for the, I think, continuing growing about the corporates like earning and net income. So from the slightly longer term perspective, this pullback could turn out to be a buying opportunity. No, Rich.
Yeah, no, that I mean it's a fair point. And as you mentioned, like when markets kind of rotate from some sectors to the others, it can be it can be healthy. It can be a healthy move, just to kind of reset. Here I'm looking at the sectors on a year-to-date basis, and we see that on a year-to-date basis, the market is up small, et cetera. But what a lot of people know is like consumer discretionary and tech. That those are the names that they're most familiar with. Those names are the only, or those sectors are the only sectors that are negative this year. The defensive sectors of healthcare, consumer staples, financials, real estate, utilities, these are the ones that are performing the best. So that is certainly something that is very interesting to see. I think
Yeah, I want to add
um,
a comment here. This is very interesting to see. We can anticipate that when institutions become defensive, they actually would allocate or they would move the capital into this kind of defensive sector like healthcare, especially healthcare that typically perform the best during the recession, right? Because of the constant cash flow. This is what traditional like finance book is telling everyone this is the way that you should go. But given this is, what surprised me is that since I think Secretary Kennedy actually I think was sworn into the office, and we anticipate the Maha moment. It's like a make American health again, right? Maha, this is a Maha movement. You typically cut the expense for from the NIH and apparently FDA, which actually into an will translate into like a maybe lower income or lower revenue, lower sales from the healthcare company. I would not actually I anticipated that to see this like healthcare actually perform so well. This is slightly surprising to me. What do you think, Rich?
I think you're right, but I think to me, you can't ignore the price action because there's a lot of anticipation of what could happen. And you mentioned the AI and AI theme, and I agree. I think many would agree that the AI is going to be transformational. But I think the early things that we see is that jobs of the job layoffs and not having seen we haven't yet gotten to the point of productivity gains and new jobs being added because of AI. And much like while we think about the cut in government spending might be a long-term positive, its short-term can be very painful as we go through the adjustment. And maybe that we see the same thing even on the private sector side where the AI adjustment, it means people getting laid off initially, which again is another hit to growth. And so what we're seeing in the stock market and the bond market is a classic defensive safe haven rotation where there's a concern of recession that's coming through that's being priced in right now. And I think I find that to be interesting. And I think necessary. I mean, when I think about it, if we go back, I think we talked about it at the start of this year. But there was a Bank of America fund manager survey that showed what investors thought was going to happen to the U.S. economy this year. And the majority thought that there would be a soft landing. But as the year ended and we came to a new year, there was a growing chorus of people that said there was going to be no landing, that the economy was going to re-accelerating, if not take
Yeah.
off further, led by small caps and deregulation and lower taxes, et cetera. And only 4% of people surveyed thought there's going to be a recession. So whether or not we see a recession, and I don't think many people are forecasting a recession right now,
No, not at
but
all.
even if
Not
the
at all.
odds go up from 4% to 10% or 15%, which is still very low odds. I mean, historically, the odds of recession are around 15%. So even if we just move back to norm, that pricing of that still starts to look like the investors are pricing in a recession simply because there was no odds of recession being priced into the market. And I think we might just be seeing an adjustment in investor portfolios to account for maybe a more realistic possibility of about 15% or 1 in 7 or so of having a recession this year. Still not a base case, but just a repricing of the odds of it. I don't know. That's how I guess how I'm thinking about it.
Well, I agree with all of what you just saying that this definitely will be something reevaluations based on all kind of information. And given the lot of uncertainty here, this is no doubt. And President Trump like continues to sign the executive order almost every day. So you just do not know what's going to happen. It's like over the next day, which actually might could have potential a big impact over either certain industry or either macroeconomic. For instance, like the impact of tariff and the war, the AI war between the U.S. and China, or even maybe some kind of a argument, technology argument between United States and European Union. So a lot of the uncertainty could hit into this kind of high-tech sector and macroeconomic. So we might continue to see until we actually settle down. But given what you just mentioned just now, I think lower corporate tax rate and deregulation, those are the fundamentally great driver for high corporate earning and higher greater economy. I still actually have a high expectation that U.S. economy would become even stronger. So to get to the point, I personally don't anticipate to see a recession this year.
Yeah, I would agree with you. I wouldn't either. I just I think there was better than zero odds of it though, and with
Of
some of
course,
the
better
cuts that
than
were coming
zero.
through.
Unless something like a happened, for instance, like another pandemic,
Yeah.
or another like a nuclear war, something that's like a hit unexpected. This is so far, if President Trump remain into the office and then continue to keep the American first policy, we might have a higher odds not to see a recession, much higher than what we could possibly saw in the
It,
in the last
it,
like
it surprised a lot of people because we haven't really seen one since I mean, well, I guess you can call it COVID and the COVID exogenous shock, but
yeah.
outside of COVID, I think we really haven't seen one since the financial crisis. And so that's kind of interesting. I
Yes,
want to
yes.
pivot a little bit because you mentioned tech, you mentioned you mentioned China before. We didn't really talk about it, but DeepSeek has been another story that's gone on about the impressive results seen in the DeepSeek models in China, et cetera. One thing I wanted to ask you about was the meeting, the story. I saw this a couple weeks ago between President Xi and the leading tech leaders of all the major tech firms, including Jack Ma,
Yes.
who has been laying low for quite a few years right now. But my sense on that meeting is that that was a pretty positive signaling by the Chinese government to the private sector in China that they're looking for the private sector's help to reinvigorate the economy, and having that led by the tech sector. I have a chart up here now of the FXI, which is maybe not the best index or ETF for China, but it's one I've always looked at, the FXI versus the SPY, so China versus the US, and since that uh, time when Jack Ma really spoke out against the government in late 2020,
Yeah.
and
Yes.
then there was a crackdown on a number of different industries for a long period of time. China has materially underperformed the US from 2020, end of 2020, all the way through until the last 6 months or so. And it
Yes.
looks like we're seeing a series of higher lows and higher highs. We've got this catalyst potentially of the government and private sector engaging to stimulate the economy, which has been struggling. What is your take on the importance of that meeting, or on other potential catalysts to where maybe we can start to see some Chinese outperformance of the US market?
Oh, Rich, the meaning by all means is actually a great signal to the private sector within the China, especially for those kind of founders in the high tech sectors, that they actually get the confirmation from the presidency. Apparently, the core power of the whole Chinese government over there, giving them like confidence to continue to invest into the China. What had happened and why the Chinese stock market and Chinese economy was depressing, just to given what the central government continued to try to crack down. I think the superpower by those kind of large cap tech like Alibaba and like a Tencent over the past or almost like a 5 years ago. At the moment, it's like we continue to see that this kind of a large cap tech pretty much take a counterpart like a US counterpart here, Magnificent Seven there, Magnificent Seven here. Those kind of large tech, when actually reaching to a certain level, they can to a certain extent have a huge influence or control over the Chinese economy. This is quite similar to what we are seeing here. If apparently a lot of people would uh, complain that we are actually seeing the oligarchy to control the government. Similarly, this is what's kind of similar concern what they had over there. So with the private sector continuing to shrink, just given the government crackdown and actually try to limit their influence over some political power to a certain extent. So the private sector lost the confidence to invest into the domestic market, and this caused a downward spiral effect over the consumption, lower the consumption and lower the economy, and given and simultaneously with the trade war between the China and the US. And this situation will actually get even worse. So this is a continued downward spiral. Now, um, once actually reached to this point with the deep six coming out, now over the past few years, the deglobalization process happened to a extent that many large manufacturers already outsource or pull their manufacturing outside of China to area like Mexico, um,
Yeah.
in India, Indonesia, or Malaysia, other like a South Asia country. So the valuation for many of the assets, like asset classes in China, has reached to a very, very attractive level. And given the what President Chang has already started to readjust the United States like a policy from in the past, maybe airlines together by Biden administration to American first policy, Chinese government especially I think President Xi saw the necessity to focus more on the domestic consumption rather than just focusing on export. Apparently, export was one of the major like economic growth engines in China in the past, besides the real estate growth. Now, real estate bubble bursted, but we saw the stabilization of the Chinese real estate market. Now here, the only mission that we focus, I think the Chinese government will focus this year will be to actually incentivize the domestic consumption that require the invigoration of the private sector. Now, this would turn out to be a perfect signal that when actually they host the meeting, many of private sector of like a business owner took it as a very, very important signal. So based on a lot of information that I have received, and we're very excited signal that this time they might actually have some kind of window to continue to invest into China. Hong Kong's market is the window of the Chinese financial market to the world. Now, it is the only window where the external, like a capital, can really get into the mainland China. That's the only window. Now, apparently, Hong Kong Stock Exchange will start to actually perceive this kind of a heat or revaluation given a lot of positive developments over there, both Chinese government's like incentive, some coupled with some kind of political gesture to power up the private sector again. And given what President Trump has adopted American First policy, which might actually disappoint some of the European ally, that I think this will be some of the capital reallocation. So they might think China could be a great player within their overall like a portfolio at this moment. So that's why Goldman Sachs, UBS, Morgan Stanley, they all issued the upwards earning estimation for I think for Hong Kong stock market.
Yeah,
That's
and when you talk about the valuation differentials, I think I forget, I think maybe it was from Alpine Macro I saw where the valuation of the biggest 10 Chinese stocks versus the Mag 7 US stocks was half the PE.
oh yeah, way
16 times
uh,
versus 32 times or something like that. And I know when I look at UBS's Holt global discount rates, which I think is a good measure of investor sentiment, the global discount rate for Hong Kong and China is as high as it was in COVID or the Great Financial Crisis, indicating that investors still see a lot of risk. Whereas in the U.S., the the discount rate is as low as it was in 2021 or going back to 2000. So investors are not perceiving any risk in the US. And so that when you see that relative valuation disparity, and then you start to see the potential catalysts like you're talking about, and we know that investor positioning is definitely long the US and short China. I think many global investors have thought China was uninvestable the last few years. So
yeah.
the opportunity for those flows to happen and happen in large size, it's not surprising to me that the bulge bracket firms sense that and are trying to get in front of that for sure. Just a couple of things. I know we're kind of getting up on some time here. To your point, like we talked about before, Europe, as we showed before, this is the stock 600 index versus the SPX over the last 5 years. If I widen this even further over the last 10 years, I mean, Europe has been lagging the US for a decade, and it's had a really nice start to the year. It could have a lot more to go. I'm not suggesting it is, but again, when we think of that relative performance, relative valuation, potential catalyst being European stimulus, European defense spending, et cetera, it intrigues me and makes the contrarian in me perk up. But I think it all comes down to the dollar, right? It comes
uh,
down to the dollar. And when we talk about that dollar overvaluation and the need for a lower dollar because of U.S. manufacturing, that mala before. This was something I heard earlier this week. Looking at when most people think about the dollar, they think of the DXY index, which is a GDP weighted index. It's pretty heavily on Europe and China to a lesser extent, in the UK, of course. And that's been kind of flat really for the last 35 years. The dollar is maybe up a little bit. So you're like, well, dollar doesn't seem that strong. However, in the other line that I show you here is a trade weighted index, a US trade weighted index, which weights the currencies by the percent of trade that they do with the United States. So Canada and Mexico and China would obviously have the biggest weights.
Yeah.
And that index, since the beginning of globalization, if you will, has gone up by 200%, suggesting that the dollar could be over, certainly has been very strong. Is it overvalued? I don't know. But it's interesting to me that the object of the tariffs that we've seen so far, Canada, Mexico, and China, the biggest trading partners of the United States, and that certainly could be aimed at getting the U.S. dollar lower to help U.S. manufacturing. But we know if the U.S. dollar comes lower, there's going to be a push for global indexes versus the U.S. index, and then maybe that's another potential catalyst. Is the dollar move on your radar right now, Tony?
Oh, definitely. Sometimes you can anticipate the market expectation is when the U.S. dollar getting stronger. That means like the U.S. economy or exports can actually goes higher. So that's a very general expectation. Why the U.S. dollar becomes so strong and not actually the U.S. stock market. That just shows the market becomes slightly defensive. So if market is very aggressive, it's not that defensive. It's typically we would like to see slightly weaker dollar that will actually help to continue to from the equity investment perspective that will help the U.S. Stock market. Now here, a lot of ways to continue to go higher. It just shows right now the investors wasn't actually uncertain about the global economy movement. So that's what I take here.
Yeah, and then maybe we'll just end on this last chart, Tony. When we think of the dollar, we have to think of course, foreign exchange is relative, but um, one of the big drivers of cryptocurrency for the last 5+ years has been the fact that there's been dollar debasement. We show that dollar versus other currencies, and it has certainly not debased as much as other currencies have, but um, crypto is not trading with a very positive tone. I'm showing here Bitcoin and Ethereum. Ethereum over the last year is now down 30% in spite of all the positive catalysts on regulation and ETFs, et cetera. Bitcoin is still up over the last 12 months, but you can see from the chart it is falling quite rapidly right now, and it's below 85,000. The support probably comes in around 70,000. This is, to me, crypto has been a very good index, very good leading index of investor risk appetite. And it even, I think, leads the risk appetite we see in US equities, including NASDAQ. You're the resident crypto expert, Tony. What's going on in crypto? Why is it trading so poorly right now?
Yeah, Richie, you're absolutely right. It's like the crypto market and especially alternate coins like price can serve as a great indicator for investors' risk appetites. Lots of retail investors or maybe Gen Z are the major players within the crypto market, not institution yet. Even though maybe we see some BlackRock actually right at the beginning of this year raised like a historical amount of the cash flow into their I think Bitcoin spot ETF. I bet, but over the past 2 weeks also saw the largest like cash outflow and movement out from the crypto market. This is actually contradicts a lot of people believe that given we have a pro crypto and pro Bitcoin's president in place that we should anticipate to see this. Now, there could be a lot of reasons. For instance, like the in security issue that in the crypto market we saw that there was, I think, a risk incidents happened last week from exchange in China. There's like over, I think, more than 100 or 150 millions of Ethereums was stolen, right? And then actually put onto the market. So this is definitely some kind of inheritance, like a factors over the crypto market in the short run. But if from the policy perspective, a lot of people would anticipate to see that uh, President Trump might sign an executive order to put the Bitcoin into the U.S. like a currency reserve. But he has been into the office for more than a month. A lot of people will say, where's this? They might anticipate to see this kind of executive order, but after a month, they haven't really seen it. So that's like a lot of disappointments over there. If you look at like the social medias, like for within the crypto or Web3, it's like this district, that was some kind of a um issues over there from a sentiment perspective, so they might not actually see what they anticipate to see. And given what President Trump has promised, like to actually to really probe the Bitcoin, well, this could be a lot of things. But another way, crypto or crypto market typically has no fundamental. They do not have for any product. They do not have the cash flow, normal cash flow as what we saw like a normal business operation, mainly driven by liquidity. This is liquidity issue and risk appetite issue will be, I think, another key player over the market. If we look at the RRP, the reverse repurchase like programs, we actually start to see the overall balance of the RRP. It declined significantly just over the last 1 or 2 months. Now here, like if Federal Reserve um, continue to hold the interest rate at its current level, or will not actually like soften their stance in April or even in early May, then could really hurt the crypto market, especially within the short term. So from the long term perspective, it really depends on whether there might be some continuing like a policy coming out from the current administration. And now today we saw the SEC actually withdraw the charge over a few like a crypto project, crypto fund that's actually shows some kind of pro gesture over this kind of innovation. But this is really need to align with the current President Trump's like a dedication, how to simultaneously cut government spending and meanwhile try to hold up the U.S. economy to grow at a rate that he anticipated to see as what he continues to claim the golden age of America, right? That's the
Yeah, for
key issue.
sure. I think interesting thing that, clearly it was the crypto bros did, certainly supported President Trump, and we saw a peak in Bitcoin right after the election. Interesting in my work when I look at it, though, when you're looking at Bitcoin wallets, the US government is already the third largest holder of
Yes,
Bitcoin. It has 18.6 billion in Bitcoin, which is larger than what it holds in terms of euros and yen and any other FX. Only the special drawing rights of the UN are larger. So in some ways, the US already has a Bitcoin reserve. And so
of course.
maybe they're just not going to sell. And so I think if that was the catalyst, that if that was the catalyst, then maybe people are going to struggle with that. But I
Right.
hear your point that liquidity is certainly going to be a key indicator for that. And so I'm watching because as liquidity impacts the crypto risk assets first, how is that going to is that going to continue to impact U.S. equity markets, et cetera?
Yeah.
I think Tony, we've been about an hour, so why don't we leave it there? We've got Nvidia earnings coming up in
Yeah,
about
yeah, very very
so.
short in an hour.
Yeah, so that's something we can we'll look at that, but we'll report back to people in about a week or two on
Correct.
what's going on in Nvidia, what's going on in the market because of Nvidia, and then any further updates from what we're seeing in DC, where every single day it seems like there's something new going on. So, Tony, thanks for joining me for another episode of Macro Matters. Look forward to catching up with you again in a couple weeks.
Yeah, definitely like to catch up in a few weeks. Given a lot of earning like report, exciting things, developments. There are exciting news almost every day, every single day from now on. So I really enjoyed discussing with you, and let's thank you for the discussion, Rich.
Thanks everyone for joining.
Yeah, thank you, everyone.